Hi, welcome to Educate Focus. My name is Kellyanne Rodriguez, and today we're going to look at a June 2014 question for question. Now, this question covers part the objective 8 and 9 of section 6 of the accounting syllabus, which is accounting adjustments. So, objective 8 and 9 requires that, you see where the asterisk is? Remember, I explained that the asterisk is CSEC advising teachers and students who are studying that it is imperative that you have practical activities within these sections because they do bring practical questions for you. So you're required to calculate annual depreciation expenses using straight line method and reducing balance method, and to prepare journal entries and ledger accounts for provision of depreciation. Now the first part of the question just asks you to give definition. So it's 2 marks each to give the definition of a fixed asset, which we now call non-current assets, the useful life of the asset, and the net book value. Now, you know the fixed asset, which is non-current asset, means to say that the asset has a longer lifespan than 1 year. And it generates a benefit for the company. So once you give the definition, you must, if you give an example, you can also ensure that you get 2 marks. So a definition with an example is a way of you capturing the 2 marks with certainty. So for example, property and motor vehicle that have a longer lifespan than 1 year. So if you give a definition with an example, you're sure to have your 2 marks. Now, useful life. You know, the useful life is the time that the asset will be used to generate the benefit for the company. It may be 1 year, 2 year, 3 year lifespan. So it's not necessarily just a current asset, fixed asset, but it also has a lifespan in which the company will benefit from it. And the net book value is the difference between the cost of the assets and the depreciated value over the useful lives. So here, once again, you can also give an example stating that if the cost of the asset when purchased was X amount and the accumulated depreciation is, let's say, 30,000 in my example here, after 2 years, then the net book value will be the cost minus the accumulated depreciation. So give an example with your definition, a short definition, and you are sure to be able to land yourself 2 marks. Now let's look at the other part of the question. So the other part of the question, let's look at the requirements first, because I always tell students look at the requirement. The other part of the requirements asks that you calculate the depreciation charge on the delivery van for the year ending the 30th of April 2014 using the straight line method. So here in part 1 of B, they ask you to calculate showing using the straight line method, but they ask you to show working clearly. Now, one of the things that the examiners state in one of the report is that when they ask students to show the workings clearly, they do the working, but they don't show it in the working paper. So show your workings when you are actually given the answer. You see, if you fall short halfway, or even if you have you write down the correct thing, but your calculations with the haste of trying to get things done quickly, for instance, if we minus 200 from 140 and you get 70,000, they will know that you know what you was doing. It's just a matter of calculated problems, right? So you will get marks for it. So show your workings clearly, please. Draw up a balance sheet extract for the van showing cost, accumulated depreciation, and net book value as at the 30th of April 2014. So they want a balance sheet extract. So this is the 2 parts we are going to look at in relation to the delivery van. So what did they give us? On the 1st of May 2013, Farley Caterers owned 2 depreciated assets consisting of a delivery van and an industrial store. The following information was provided. So they give you the cost price and they give you the net book value for both the delivery van and the industrial store. Now they say the company charges depreciation on its assets as follows. The delivery van is 30% per annum using the straight line method. And the industrial stove is at a rate of 20% per annum using the reduce and balance method. So if you have to calculate the delivery van using the straight line method, you focus on the delivery van. Don't go looking between industrial stove or look for any hidden agenda of the examiner. All they want is for you to calculate it using the straight line method. So the cost of the delivery van is 200,000. So here I already did the working for you because it's a very straightforward question. You put depreciation on delivery van for the year ending 30th of April 2014. The cost of the van is 200,000 and the rate of depreciation per annum is 30% of cost because it's a straight line method. So straight line method is the percentage based on the cost of the equipment, right? So rate of depreciation per annum is 30% of cost. So 30%, so I put 200 multiplied by 30%. So I'm showing the examiner my working, which is important. It's imperative that you do this because the examiner clearly asks for it. So 30% of 200 is 60,000. Depreciation charge for the year at the end of April is 30,000. So here you see depreciation charge for the year ending 30th of April 2014 is 60,000. And that is 3 marks, straightforward. If you give your workings properly, if there's any error along the way, the examiner will give you it correct. Now to do the balance sheet extract, you must find out the accumulated depreciation, right? And they actually give you a hint here. Drop a balance sheet extract for the van showing cost, accumulated depreciation, and net book value. So this is the 3 things that they ask for: cost, depreciation, and net book value. So I already highlighted for you. So this is what the examiner is asking for. So who we doing it to? Farley Caterers, balance sheet extract as at the 30th of April 2014. And you want to do your non-current asset at cost, depreciation, and net book value. Now the delivery van, the cost we already know is 200,000. Now what we don't know is what is the depreciation for the previous years. You just have to do a little work in the find out. So if the cost was 200,000 and the net book value was 140 at this point in time on the 1st of May 2013, then the accumulated depreciation for that year would have been 200 minus the 140, which would have been 60,000. So 60,000 was the depreciation represented within here as at the 1st of May. Because your cost minus your net book value gives you your depreciation, your accumulated depreciation. Now don't forget the charges for the year. Charges for 2014 would have been 60,000. You already calculated it in part 1 of the question. So total accumulated depreciation would have been the year before plus this year now gives you 120,000. So the delivery van will be 200,000 minus 120, giving you a net book value of 80,000, clearly showing up what is required of you in the exam. Balance sheet extract for the van, that's the van, not the industrial stove, showing cost, accumulated depreciation, and your net book value. This is all the examiner had asked you for, and it was worth 7 marks. Now let's look at the other 2 parts of the question. The other 2 parts of the question also, which I already completed here for you because it's a straightforward question as I stated. It's a calculated depreciation charge on the industrial stove for the year ending the 30th of April 2014, showing the reducing balance method. Show workings clearly. So once again, you have to show your workings clearly. And the part 4 of this question asks you to show the provision for depreciation account for the industrial stove, starting with the amount of accumulated depreciation as of the 1st of May 2013 as a balance brought forward. So if you look at the information given, you have the industrial stove being cost price 60,000, and it already has a net book value at 38,400. Now remember, reducing balance method is calculated at the net book value because it is reducing. So it calculated at the reducing balance. So we don't have to do like we don't have to calculate it, as we did previously on using the cost when we did the straight line method for the delivery van. In this case, we have to calculate it using the net book value because it is done using the reducing balance method. And the net book is reducing. Now I'm stressing on this so that you remember. Cost is for straight line, net book value is for the reducing balance method. So all you need to do is at the 1st of May 2013, showing your working clearly, the net book value was 38,400, like it's right here. And you want to find how much percent? The industrial stove at a rate of 20% per annum. So you want to find 20% on the net book value, which is 20% of 38,400. And if my calculations is correct, it will be $7,680. Now, The net book value as of the 30th of April 2014, I calculated one time just for working case, is the net book value minus the now depreciation, and it will be 30,720. But what the examiner is asking you for is for the depreciation for the year, which is $7,680. Now, looking at the part 4 of the question, they want you to draw up a provision for depreciation account. So you have to do a proper ledger account, which is your general ledger. You put date, details, folio, and amount, date, details, folio, and amount. Now, what year you're going to do this at? The year fall into May. The year does not fall January, December. So that is the reason why I put 2013, 2014, because it falls from the 1st of May to the end of April 2014. So May the 1st, 2013, the balance brought down for the stove on accumulated depreciation. You just have to work it out. And how do you get that? If the cost was 60,000 and the net book value was 38, once again, to find the accumulated depreciation is the same manner. You just minus the cost from the net book value. And cost minus net book value, as you can see in my working here, the depreciation, accumulated depreciation was 26,600. So therefore, on May the 1st, which is when the information was presented to you, the balance brought down would have been 21,600. Now, depreciation charge for the year will be added to the accumulated depreciation. This is the amount that will be recognized in your income statement for the financial year. So, depreciation charge for the year as you calculated here was $7,680. So at the end of April 2014, which is the financial year end, charge to your income statement would be the depreciation for the year, which was $7,680. And when you add both together, you will get the accumulated depreciation, $29,280. To close your account in 2014, April 30th, your balance carried down now will be $29,280, the balance of your ledger. And it will be brought forward or brought down at the beginning of the next month, which is May 1st, 2014, for the same amount, $29,280. And this would have landed you 20 marks, just to be able to know the difference between how to calculate your depreciation based on straight line method and the depreciation based on your reducing balance method. A quick reminder, straight line is based on cost, reducing balance, as the word state reducing, is based on your net book value, which is already reduced by the accumulated depreciation. If you know how to drop your ledger accounts, it will be straightforward. You just start with your balance brought down, which is always a credit balance. You charge the amount for the year to your income statement, and you get your accumulated depreciation to close off your account. And here you go, 20 marks. And this will cover accounting adjustment, section 6 of the accounting syllabus, part A and part 9 of the objective. All the best in your exam. Thank you once again for joining me. My name is Karen Rodriguez, and look out for some other questions on the syllabus that is imperative that you have practical activities in order to pass the exam.